Hey guys, Clint Coons here, and in this video, I'm going to teach you how to take out tax-free money with a 1031 exchange. Okay, let's get started. All right, so here's the deal when it comes to 1031s, all right? If you ever watched one of my videos on them, you read up on 1031 exchanges, the way they work is that you have a piece of property. Let's say we bought this property for $1 million, correct? And now it's appreciated in value and it's worth $2 million. And we want to sell it, but we don't want to pay tax on that sale. If you went to a CPA or you go to a qualified intermediary to engage in a 1031 tax-free exchange, they would tell you this. You sell the property, so I sell this property, the money will be held by a QI, qualified intermediary. I will go out and identify up to 3 replacement properties. So let's say I find 3, or you don't have to find 3. Let's say I just find 1 that I want to buy. And this property here has to be at least the value of the property you're relinquishing. So that has to be at least $2 million. Many times when people sell, though, they want to pull cash out of the deal. Your CPA will tell you, if you go out there and you find this piece of property, it's $1.5 million, that means you're going to receive $500,000 cash out of your 1031 exchange. It's called boot, and that's going to be taxable to you. So they'll encourage you then to gross this up to the full $2 million or more to avoid any income tax recognition on a 1031 exchange. So people then tend not to pull cash out on their 1031 deals because they don't want to pay tax on it, right? I don't blame you. Kind of defeats the purpose. Well, here's a different way to look at how you're doing an exchange. See, the deal here is that when you take out cash, the key question should be, is it taxable to me, right? By pulling that cash out. Is it going to be taxable? And if we can make it non-taxable, then that's tax-free money, right? Okay, so here's what we got to do then. There's 2 strategies I'm going to share with you. One has to do with property. Let's say this property is pre-2017. All right, so let's say I bought this house here, this asset in 2016. I bought this property. It's gone up to $1 million, and I want to pull out $500,000 on the sale of that asset. But I know I'm going to have to pay tax on it. So what I'm going to do is I'm going to find $1.5 million in replacement property. I'm going to buy that replacement property. So I'm going to close on this deal. And then at closing, I'm going to get $500,000 in cash, which is taxable. But this pre-2017 property, the thing about it is that it did not qualify for bonus depreciation. So now what I'm going to do with the replacement property that I've bought, here it is 2022, I'm going to turn around and I'm going to perform a cost seg study on that property. By performing the cost seg study, as you watch my other videos, I'll put them in the links. If you're not familiar with cost seg strategies, I've got a few videos on it. I'm going to accelerate the depreciation. Now, since this property was purchased in 2022, it's eligible for 100% bonus depreciation. So if I break all the parts down in this building that I can cost seg out, and typically on a 1.5, you're going to get close to $500,000 in tax deductions. I'm going to cost seg it with my bonus, and I'm going to take the $500,000 and use it to offset the $500,000 in income that was paid to me as boot. That's how you get there and you make it tax-free. Now you might be wondering, well, Clint, this was pre-2017 property you're talking about. What happens if I have purchased property since then? What do I do in that scenario? Well, you do the exact same thing, but we just tweak it a little bit here. So now what I would do in a scenario like this is I would take the exact same property. You bought it for $1 million. Instead, we bought it in 2020. And now that property has gone up in value and it's worth $1.8 million. So you want to pull out $400,000 cash out of this deal and you don't want to pay taxes on it. So what you need to do now is you need to figure out, how much depreciation did you burn up with this property? Maybe you didn't do a cost seg already. Then it's wide open. You can use the last strategy I shared with you. But maybe you did cost seg some of that property already, so you've depreciated it down. So what we do on the next deal is we'll take this $1 million, 1.8 we're going to receive, work with our QI here. We're going to go out, we're going to find some replacement property. Maybe you find 2 replacement properties. But this time we're going to have to go up. All right, so let's assume that if I want to pull $400,000 out of this deal in cash that I want to put in my bank account, that means I have 1.4 left to invest. So I'm going to want to find a lender that's going to loan me, let's say 1.5 to $2 million. So now I need to look for properties that are, in the range of 3 mil right here. So I'm going to fund this with debt to go in and buy these replacement properties. And the reason why I'm doing this is because I'm going to increase my basis in the properties so I can do, again, what I had already done possibly with this property or in the strategy I just showed you. Because if you took this property and you depreciated all of its short-term assets here on the depreciation schedule, and you already took out of this deal $400,000, you can't turn around and do it again with your replacement property unless you add value. So the way we add value is we buy more expensive replacement property and we fund it through debt. So now I'm making sure that when I do this, I get the $400,000 cash out, but I gross the value up to $3 million. So I raise my tax basis in the property. So I'll come back in again and do a cost seg study on here. I'll figure out how much of that I can deduct. That'll probably get me close to $400,000 in new assets that I can take and offset that $400,000 in cash, that's called boot, that I pulled out of the deal when I did the 1031 exchange. So what this comes down to is numbers. What you need to do is work with someone who understands how the tax side, the cost seg, and the 1031 work in conjunction, so that when you go out there and you're selling a property, you don't have to roll all the gains in for fear that if you don't, you're going to pay taxes on the boot that you receive on the exchange. I hope you got a lot out of this. If you're considering doing a 1031 exchange, 2022 is a great year to do that, or any assets you've acquired since 2018 to 2022 will still be eligible for the bonus depreciation going forwards. So you got a lot of planning there that you should be considering if you want to do these types of deals to make sure you're eliminating your taxes and getting tax-free cash at the same time. If you like the video, guys, hit the like button. Be sure to subscribe to the channel. And oh, by the way, if you're not aware of it, I do monthly, I do a YouTube live session. Be looking out for it. I've got new topics and it has an opportunity for you to ask your questions live of me as we're covering, limited liability companies for residential real estate, short-term real estate, land trusts, flipping property, you name it. We're going in depth on it when it comes to tax and real estate asset protection. Take care.